Pratik, good morning. Thank you for joining us. While it's easy to make a case that why markets are expensive and why markets should go down and the rise should get arrested, that is not happening. So what does one do in this market? Because based on historical benchmarks, it's an expensive market to invest in. But if markets they continue to rise, you're also missing on this entire opportunity of making money.
Nikunj, hi, good morning. That's a very good point you're making, that that the market does look expensive based on historical valuation trends. We have the Nifty, which is trading at about 24 and a half times FY22 earnings, about almost 22 times FY23 earnings. And at Kotak, we are actually assuming fairly strong earnings growth this year, about 31% for the Nifty, next year almost about 15%. So despite that, the headline multiples do appear expensive. But your point is valid that if you had sold out, you would have lost money and the market is continuing to rise up. In our view, basically, there are no major local triggers which could cause the market to correct in the short term, at least. And also, if you keep in mind, our market for the last, I would say, 4 to 5 months has been driven really by local money and mainly the retail and HNI investors who've been really big buyers. We've seen, the retail investors, for example, in the futures market, we've seen single stock long positions go up from about $7 billion in early April to north of $10 billion right now. And the foreigners have generally been absent from the market. And basically, if you saw the Fed's announcement yesterday, they've actually managed the taper guidance really well, which was one of the big fears for emerging markets in particular, that the Fed would start tapering and that could cause a big sell-off and so on. We've always been in the camp that there would not be a major sell-off. And the way the Fed has managed it has been actually quite impressive. They've effectively guided for a taper starting from November, going all the way till the middle of next year, and no interest rate hikes in 2022. Rate hikes will probably come in from 2023. So you'll have a sort of benign global liquidity environment for the next 6 to 9 months. After that, let's see what happens. And you're right, in the short term, the market could continue to inch up. The local factors are very, very positive. The vaccination pace has been picking up, so hopefully we will not have a third wave. The underlying economic recovery is actually picking up. We're seeing sector after sector, whether it's IT services or the real estate sector or chemicals or across the board. Companies are generally sounding very, very positive. So in the short term, you're right that there isn't an immediate trigger that we see. But I think one should not ignore from a medium-term perspective, maybe over the next 6 to 9 months or 12 months, the impact of the liquidity withdrawal by the central banks. That's something which can actually impact all EMs, including India. So, but that risk is probably still a few months away. So in the short term, you could carry on, but I think one needs to be aware of the medium-term risks that are building up.
So my question is, what does one do? Sit on cash? Because if risks are building up, and if the risk-reward ratio is, let's say, not 80-20 in favor of going long, it is 50-50 or 60-40, whatever that number is, depending on what your view on the market is, what should one do? Buy puts or sit on cash or wait for a decline to buy again?
So I think for those who can, yes, buying puts is definitely one strategy. The volatility, the VIX is quite low. So you can get puts relatively cheaply given the relatively bullish environment over here. The second main thing I would actually suggest to institutional investors as well as retail investors is to actually reduce the risk levels in their portfolio, reduce portfolio risk. So what that means is, companies or businesses which are inherently weak, which have just benefited from the market rally, one should look at booking profits in those kind of businesses. Second is where valuations have really gone out of hand, and even on the next 2, 3, 4 year level, it's difficult to justify those valuations. So where you might see an impact as and when interest rate increases happen next year. Or companies where the leverage ratios are very high or unacceptable, or governance concerns are there, and yet these stocks have rallied as part of the overall market rally. That's another area to sort of cut back positions on. And also in particular, I would highlight generally the small mid-cap sector, where a lot of companies, a lot of stocks have done exceptionally well. If you look at the BSE mid-cap index, it's up about 40 odd percent this year, and it's about trading at about, I think, 25% above the 2017 peak. And that itself back then wasn't really cheap. So mid-caps in particular is one area we would be careful about. But the overall point I'm making is that given the risks are building up, given that valuations are beginning to get quite expensive, one should look at cutting back portfolio risk in particular.
Okay, so you're finding the mid caps valuation to be high at the moment. So what would you suggest? Move momentum towards the large caps?
Yeah, I think definitely. I mean, mid caps, I think one needs to be quite careful. Generally, these companies, while they do well in an economic recovery upcycle, but one also has to keep the valuations in mind. In a lot of cases, the mid cap stocks are trading at a significant premium to their large cap peers. And if you do have interest rate increase or for whatever reason, the execution doesn't pan out as what is being implied by the stock prices, you could have a fairly sharp correction in the mid caps. I'll just give you an example. For example, if you look at the mid-cap IT companies or the mid-cap chemical companies, the valuations over there have gone way above some of the larger cap peers. So those are segments one I would recommend you need to be careful and move your portfolio more towards the large caps in those respective sectors.
Okay. We were just discussing how the mid-cap IT stocks have given better returns than the large caps. So you've also brought up that particular point. But when you look at the large caps, and you're very concerned by valuations, you're seeing FMCG valuations, for example, being really high. You're seeing real estate that is making a comeback. You're seeing steel being a little all over the place. So within the large cap story, what are you trending towards? Because the IT stocks are also quite high in the large caps and the consumption stocks.
Sure. So I think you're right. The consumer stocks, we are finding it difficult to recommend at these levels. Valuations are quite high, and the growth rates aren't really picking up. We see limited upside to earning surprises. So one area we would recommend within the large caps is still the banks, which have actually underperformed. On a relative basis, the banks still offer a good value compared to the rest of the market, and especially the private banks. That's where we are focused on. Where we think next year credit growth will pick up, the credit cost will continue to come down, and a lot of these private banks will actually be a beneficiary of the ongoing consolidation within the banking space. They'll continue to gain market share at the expense of the PSU banks. So the private banks is one space we would recommend. Insurance is another one similarly. A lot of the insurance companies were quite badly impacted during the COVID environment because of the high claims being made because of all the COVID deaths. But typically, we've seen worldwide, as and when you have a major disease outbreak or a pandemic, after a gap, you start seeing the insurance growth picking up once again, and that comes back actually far more strongly. The other segment you mentioned is IT services. We are actually still quite positive on IT services. We think this is a multi-year cycle. The migration to cloud services for a lot of the global customers of our Indian IT vendors has only just begun. We're still in the early stages. This can carry on for a couple of years. And while, yes, you're right, the valuations have gone up compared to, let's say, where they were a year ago. But likewise, the growth outlook and the visibility on the growth has also gone up. And don't forget, these are companies which are generating a tremendous amount of free cash flow. The ROEs are very high. The balance sheets are very strong. Governance levels are very good. So especially keeping in mind, we have the risk of the withdrawal of global liquidity from, let's say, early next year, then these companies are actually going to be very well positioned to offset against that. And meanwhile, you have the strong growth environment, and you might even have earning surprises. Like I said, our analyst estimates are generally above consensus for most of the IT companies. So IT services, the private banks, the insurance companies, these are some sectors. And also I would argue even the metal stocks, the steel and aluminium companies, we've seen a bit of a breather there lately given the concerns over China. But our view is that the Chinese situation is not as severe or not as bad as some of the press headlines suggest. And we think this is an opportunity to actually accumulate over there.
Pratik, just wondering how good is the realty story and how much steam does it have left? Even at a time as we speak, you've got some excellent, numbers coming in terms of the largest single-day sales for Godrej Properties' latest NCR project of its second phase. You've got a stamp duty cut coming in Karnataka, and the Mumbai sales continue to hold out and beat their previous records. Having said that, the stocks already have moved a fair bit. But do you think they're good to go for more?
So in real estate, we're still positive, although obviously the easy money has already been made. As you said, some of the drivers are still very much in play. You've got property prices which haven't really gone up too much in the last few years. The affordability levels have actually increased, driven by a combination of largely stagnant property prices, increasing salaries over the last 5-10 years. And even if you leave out the pandemic period when you had actually salary cuts, a lot of that has been restored. We're seeing a boom in the segments like IT services and chemicals and the financial services, the startup ecosystem. The consumer demand is very high. And obviously, after the pandemic, we've seen a lot of people wanting to upgrade, move to bigger houses or buy a new house and so on. So the demand environment is actually very strong. I think one thing which is not priced into the real estate stocks right now is an uptick in prices. Right now, these stocks have been driven up more on expectations of higher volume growth, new project launches, a lot of the inventory getting cleared. But there is a chance sometime next year, we've already started seeing that happening in some cases this year, where property prices start going up, especially at the high end and mid end. And that's something which could be a way to, which could drive these stocks higher. But I think more than the real estate sector or the property stocks in themselves, what we are recommending for investors is to also look at the housing finance companies, which actually haven't moved as much. And there we think, there's a chance for the loan books to actually grow quite substantially in the next couple of quarters. We've seen funding costs come down, and we are seeing a big uptick in the home loan business. And these stocks, like I said, the valuation is still relatively attractive. They have underperformed. So we actually would, within the two, we would prefer the housing finance companies rather than the pure play property stocks in themselves.
Sure. Pratik, the other pocket, which is, kind of not the market darling, has been autos. They've been grappling with the semiconductor chip shortage, the raw material cost pressure. You've seen many of the motor majors, be it two-wheelers or passenger vehicle majors, they've actually undertaken 3 to 4 price hikes in this year itself. But do you think that the time to buy autos is now when the news is unfavorable?
I think firstly, in the auto segment, you can't generalize, in my view. You have to break it up into different subsegments. You have the two-wheelers, you have the passenger car segment, and then you have the four-wheelers, the CV segment. And then you also have the auto ancillaries. So a preferred segment within all of these is actually the auto ancillaries. The main reason being at the OEMs, we still have the uncertainty and the structural risk of how the EV plans pan out. We still don't know for sure whether the incumbents will have the product pipeline and the designs and the infrastructure, the technology to cope with the new entrants and in the EV space. For example, in the two-wheeler space, we've already seen Ola announce some very aggressive plans. We've already seen very aggressive bookings. So it remains to be seen how the two-wheeler incumbents will respond. So two-wheelers is one segment we would be avoiding. We have a cautious view, generally a negative view on the two-wheelers. Passenger cars, frankly, there's only one player, more of a valuation call. We don't think growth is going to be that strong, and inventory levels are not that high. There's a chip shortage issue, which we think will persist for much longer than what people expect, and that could cause a downside risk to earnings estimates. It is the commercial vehicle segment within the auto space that we like, where we think, as you rightly said, right now things are a bit down, and now is the time to get into some of these stocks. But again, the stocks have already moved up quite a bit in the last year or so. So the upside from here on is probably just about 15-20% or so over the next year or so. But the auto ancillary segment and also within the OEMs, the ones which are more export oriented, those are the ones we would actually be going for. Given the PLI schemes that are coming in, given the steady improvement in India's infrastructure and the logistics costs coming down, a currency which is sort of likely to gradually weaken over the next few years. So therefore, it's more of the auto ancillaries and the export-oriented OEMs which would be preferred picks within the auto sector.
Sure. Pratik, great to have you on the show today. Good speaking with you as always.
Thank you very much. Thanks.